Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories. I'm Govindraj, Ethiraj. Earlier this week, Prime Minister Narendra Modi concluded a successful 5-day visit of the United States of America. The trip was high on excitement and hope. Here's a report on the key takeaways.
Prime Minister Narendra Modi's first official visit to America generated a lot of anticipation in the US, largely of course to understand the plans that the new Prime Minister had in mind for India. On Tuesday, Modi met US President Barack Obama at the White House. The two leaders issued a joint statement that promised to take the Indo-US relationship to new heights. In the first leg of his visit, Modi spent 4 days in New York. He addressed the United Nations General Assembly and later a huge gathering of Indian Americans at the Madison Square Garden, where he announced some big concessions, including lifetime validity visas to people of Indian origin. Modi also met 50 top US lawmakers and 3 governors, including South Carolina's Nikki Haley. Describing India and the US as natural global partners, Modi sought continued access for Indian services companies in the US market. He also urged US companies to invest in India. In the discussions that followed, both nations discussed the Bali meet of WTO. Modi coined a new term for FDI, First Develop India. The US also pledged to help develop 3 Indian cities as smart cities. These are Allahabad in UP, Visakhapatnam in Andhra Pradesh and Ajmer in Rajasthan. Modi hoped that both nations will be able to find solutions to India's food security needs.
हम भी मानते हैं कि विश्व के साथ हमको काम करना है, लेकिन मेरे देश में गरीब लोग हैं। गरीबों को भूखा रख करके हम नहीं चल सकते और इसलिए फूड सिक्योरिटी एंड ट्रेड फैसिलिटेशन दोनों चीज़ें एक साथ चलनी चाहिए, ये मेरे देश का आग्रह है।
Well, joining me now to discuss the impact of the Modi visit to the United States is V. Vaidyanathan, Chairman of Capital First, and Mr. D. Rathi, Group Executive President of the Aditya Birla Group, which also has investments in the United States. So, let me begin with you, Mr. Rathi. It's not just the US visit, which of course has been a success. Mr. Modi also went to Japan. The Chinese president came to India. So, all in all, it seems to be building up to a very impressive economic climate. Would you agree with that?
I think I'll completely agree with that. And coming in the backdrop that we haven't done much in last so many years is more prominent, and it creates much better impact. That look, a country which was so much close seconded or not having any kind of visible business relationship is doing so much to develop good relations with all major economies as well as all its neighbors.
And from your vantage point, what is it translating into, or can it translate into in coming months and years?
It will translate into economic benefits for India in course of time. You see, you have started. Now Modi's visit of 5 days just cannot change everything in a go. I think it's like, he has opened a main gate to the building. Now it will take time, but everyone is very positive. I don't recall in my life memory that which Prime Minister of India has received so much of reception from all segments, be it the US, Indians settled in US, be it the businessmen there, be it the congressman, or be it the president himself. I think everybody has given him a grand reception. And it is not based on just one thing, but based on every subject which has touched has been received well. So I think I am quite positive that our relationship with the US will improve dramatically in time to come.
Okay. Vaidyanathan, so the mood is there, right? The spirits are positive, and the animal spirits in almost. But is this sort of moving into the next step of conversion, and what are the challenges therefore?
First of all, we must acknowledge that this was a complete rock star reception for him in the US, and in fact getting the Chinese premier to come and sit on a jhula in Ahmedabad, and it just says that the Indian soft power is beginning to assert itself, and I think he has managed to achieve that in the first 100 days, and that by itself is a big achievement. Number 2, in terms of people are now saying that look, things have not changed on the ground, projects exactly have not started moving, but certainly because sentiment has gone up, people are beginning to buy more cars. You can see it in the car sales, you can see it in the two-wheeler sales, you can see it in the consumer durable sales. So already you are beginning to see some movement on the demand side, and that's good news, because with demand people will start having the confidence to have more production. One data point I can share with you is very important. Until 6 months to 1 year ago, many companies that we knew of, whether the broking companies, finance companies, banks, many of them were talking about we have to shut this division, we have to reduce the number of people, we have to de-hire 100 people. Now suddenly everyone is wanting to hire people by the hundreds and the thousands. So
in financial services.
In financial services. Okay. So whether or not things have started, projects have started moving, hiring is back.
So at least the lubrication for the economy is getting lubricated itself. I mean,
hiring is back. It's a big thing actually.
Okay.
So it's all portents time for good things to come, and I think it's just the start.
Okay, Mr. Rathi, let me come back to the question that I was asking earlier. So what's the conversion that you will now look for?
Well, let me go back to the basic point. It's for the first time that India has been projected so well. India has been projected as equal partner and not, just a seeker of everything. So, and now conversion always takes little time. You see, he has made several statements in US, like, he says he will remove several bottlenecks which have irritated the FDI investment and all that. He says in course of time he will remove them. He is known to act fast. So I think once that happens, and we of course have to make allowance what's going to happen in the US economy itself in terms of their interest rate, or there are some setback in economy as well for one or the other reason.
Right.
But I think if you account for that also, I don't think it is going to take very long for investment to come in the country.
Right. So what about as a large Indian conglomerate in India, what are you looking for at this point of time, or are you happy with the way things are going? I mean, if we were to keep aside the cross-border developments that we've seen.
See, if I were happy, there will be very little debate to be done. You see, we are so much behind in most of the things that I look forward to things happening. I think first thing I would like to look is infra spending. It has been stopped for a long time. Infrastructure is something which gives boost to economy very quickly. So I would look at that. Secondly, investment in manufacturing. If you go back, I think we haven't seen any significant investment for last 2 years. We have surplus capacity built in, so demand has to grow and investment has to start. My major worry would be this, that look, if you don't have investment coming in now in the capital expenditure, then what happens after 2 years? Economy will slow down drastically. So if you are looking at 5.52 going to 7% growth, you need to have investments going in, and for that infra spending is the key.
Right. Okay, so Vaidyanathan, maybe come back to the US question again. So if you were to look at the way the whole US visit has been approached, all the work that's been done, is this also suggesting to you sufficient determination to get things done back at home? And to some extent, what are we taking from the US, and then what can India take away from,
I somehow feel that when he's making these promises publicly in the US, to the Indian NRI audience, and in a way the message is also meant for the people back home. So publicly, he's forced to act, right? So people are asking, when is action we are talking? I feel that action is just on its way and he has to do it. Number two, from the US point of view, they are now not talking of India's 1.8 trillion economy, which it is now. In many ways, we know we have performed below potential clearly last 5 years. But I think US is already thinking of India being the $4 trillion economy in 10 years from now, and they're already pitching India there in the kind of stature they're giving us, because it's not that the economy of today, they are actually saluting the economy of tomorrow and almost giving the kind of a rock star treatment to India, at least certainly to Modi.
So in some ways, that's again building up
it's expectation, and that's good in a way, because against expectation you have to deliver. This is democracy, people are watching you. So you can't make promises and not deliver. And I think particularly with the kind of mandate 282 seats that now people will definitely say, and people will say, saying that, man, we gave you this mandate, now move.
Okay. Mr. Rathi, from an industry point of view, what is the one or two things that you take away from this visit and all the earlier interactions we've seen with China and Japan? And what is the one or two things that you would want to see action in first, or the action areas first?
See, he has touched upon several points. When it comes to industry, as I said earlier also, that I want investment to come in. India lacks capital. We need huge capital to build infrastructure. We need capital to build manufacturing facilities. So one of the most interesting thing which one would want to see is FDI coming back in a big way, and that will give boost to the economy in many ways. The second thing which I want to see, as I said, is that manufacturing taking off. Manufacturing has not played its role in the growth for last 2 years. In fact, we have seen negative, we have seen, nominal growth in this sector. And I think manufacturing is key. No country can go only on the basis of services unless it's, of course, is a very small economy. Right. That's a different point. Ultimately, services grow on the piggyback of manufacturing. So that is the second thing.
Right. So bring back that. So Vaidyanathan, from a financial services point of view, so do you see this visit and this whole sort of exchange with the US helping more or triggering more capital flows?
There is no doubt about that at all.
Okay. And that was happening in any case?
It was happening in any case, but actually, there are a set of the economy started moving again. So when we say money follows real activity. So we will certainly begin to see manufacturing. He's talked of manufacturing as the big next player of the economy and so on.
And there was the whole Make in India campaign.
Make in India campaign. So naturally, as a result of which economic activity will take off. Last year in 13-14, projects worth, as per CMI data, 6.7 lakh crores are either shelved, abandoned or stalled. Now this government is obviously trying to turnkey them and get them going. When that starts coming, we will need FDI, and FDI just chases growth. So clearly, I think we are already talking of 5.5% growth next year. We're talking of 6.5% growth year after that. And if all goes well, maybe 7.5 is not too far away, maybe 3 years away. When we're talking of that kind, money will just flow. It will flow to financial services, it will flow to manufacturing, it will flow to every sector. And I think it has, of course, India's got to do a lot more to make use of it, but it will flow.
But clearly, we've the platform on which we are standing today is a very strong one. And
definitely
has
stronger.
Been very, very well built by all these visits, and particularly the last one to the US. We have run out of time, gentlemen. Thank you so much. We will come back after a break when we will discuss the monetary policy impact. Hello and welcome back. Here with Policy Watch. For the fourth time in a row, Reserve Bank Governor Raghuram Rajan kept policy rates unchanged, citing risks to the 6% inflation target by January 2016. Going forward, any decision on rates will depend on inflation. Here's a report.
Reserve Bank Governor Raghuram Rajan on Tuesday left all key rates unchanged, citing increased risks to inflation and the difficult external situation, especially on the geopolitical front. This is the fourth consecutive time that the RBI has kept key interest rates unchanged, despite the industry's demand to cut rates to boost the economy. The short-term lending rate now stands at 8% and the cash reserve requirement of banks at 4%. The statutory liquidity ratio has also been retained at 22%.
As far as the rates go, we didn't make any move. But I think what you should read in the policy is both our views on the evolution of inflation going forward. So this is flexibility for the banks. It doesn't say anything about the overall path of SLR and where that will be. The progress that you should expect is that over time, as government finances improve, SLR will be steadily cut to a level which is consistent with the liquidity needs.
According to the RBI chief, the momentum of activity in all sectors of the economy is yet to stabilize.
We reiterated, if you look at the words, we reiterated broadly the guidance that we gave in the August policy, but also emphasized that at least the data developments since August have been positive, that the monsoon has been better than expected, and of course oil prices have come down significantly.
Inflation as measured by the Consumer Price Index in August slowed to 7.80% from 7.96% in July. Wholesale Price Index based inflation also fell in August to 3.47%, near a 5-year low. Rajan, who raised rates thrice since last September, has been adamant that inflation has to be controlled if the country wants to get back on the path of the high economic growth.
Well, joining me now in the studio, Prakash, Chaturvedi, investor in the markets, and Dr. Shubhada Rao, Senior President and Chief Economist at Yes Bank. Thank you both for joining us. So let me begin with you, Shubhada. What's your takeaway from the fact that this monetary policy did not do what it was supposed to do?
I don't know about the part of supposed to do, but we
Or
definitely knew that there was practical unanimity, near unanimity, that this time there would be a status quo. I think the credit for that goes to the Reserve Bank of India in getting practically all set of expectations at one end, which is of no rate change. We can debate about whether it was correct or incorrect from the market perception, But as economists, we would believe that I think it was the right move. The battle on inflation is not yet won. So a status quo is what most of us expected, that he would not touch the rates.
Right. Okay. So let me come to you. How do you see this from a market impact point of view? Is this something that can change things? Would it actually impede economic growth?
See, markets work on expectations, right? And clearly the markets of the next few months and weeks will be driven by 4 important drivers. One is sentiment, second is actual earnings growth, third is global funds flow, and fourth is news of the day. My feeling is that if you look at these 4 things and look at the monetary policy and interest rates, there is expectation, a huge expectation if I may say, that somewhere over the next 1 year or 18 months, there would be a process of a secular decline in interest rates, which I think is obviously very positive for the markets. Whether markets are expecting that it happens tomorrow, I don't think so. I think clearly there are several trends which are favoring a medium-term decline in interest rates. Oil prices are coming down. Inflation, while maybe not under control to the satisfaction of the RBI, is not going up, and there has been some fiscal consolidation which has merited a pat on the back from some international overseas rating agencies. So I think there are several positives going for the economy and for possibly a medium-term argument for a more moderate.
All of which could also be argued to say that it's time to loosen up, isn't it?
Yes. So I think the markets are expecting that, but I think there is still some flavor of patience, and I think the feeling is that over the next maybe 3 months or 6 months, we will run into a period where a more benign monetary policy is what.
Right. And I'll come back to the benignness of the monetary policy in a moment. But Shubhada, if we are saying that retail inflation target is 6% by 2016, now is that something that should necessarily weigh on every decision that we have to take today?
Not necessarily, because we want not just the print of a 6%, but a visibility of 6%. And as Vaid was talking about, the enablers of getting to 6%, you need a quality of fiscal adjustment, you need a supply side of the economy getting better, you need some kind of stability in commodity markets, which is very much underway. I think the uncertainties on the global front, 2 of them, particularly one, the geopolitical risks, yes, they haven't really impacted adversely the commodity regime, but they could, and at any given point in time of inflection, the turbulence could be much severe than ever. The second part is, of course, the turning point of the US interest rate cycle, the normalization. I think these are the 2 external risks that one would be watching out for, but quite true that benign conditions have developed over the last few months. Growth is looking better, inflation not very better, but definitely getting better. Inflation trajectory is looking comfortable along the glide path of Reserve Bank of India. But more importantly, I would quickly like to add that 8% inflation by Jan 2015 was predominantly the role of monetary policy. A 6% inflation will need complementarity between monetary and fiscal policy. You obviously cannot have, the kind of fiscal stimulus that you used to see earlier on. You need, better spend.
And therefore that should come very soon, or we should see signs of it.
That is something that we expect.
Right. So wait, coming back to, you talked about earnings growth, and how is that whole part of the world looking? I mean, are companies now beginning to, be sort of more nimble and realizing the benefit of an economy that's loosening up?
I think at the ground level there are early green shoots, and several businesses are feeling that there is a positive uptrend in demand. Certainly businesses in areas like IT, etc., have come back with good and positive news. So I would say that the jury is still out whether we are going in for a sustained uptrend in earnings over the coming many quarters. A lot of that would depend on how the GDP growth shapes up and what happens.
But what about interest sensitives? I mean, we're talking about huge investments in infrastructure, in so many large projects, which are now coming back on track.
Sure. So I think it's happening at a reasonably moderate and slow pace. I'm not too sure if too many of these projects are sort of very optimistically coming back on track. And certainly the outlook for interest rates and interest rates declining would be something that these projects would wait for. Let me just make another very different point, which is related to the overseas interest in India and fund flows. And we have seen that a decline in interest rates and increase in overseas interest normally go hand in hand. And the overseas interest increasing beyond a point precedes the decline in interest rates. And we have clearly seen that there's a huge interest in India, and the kind of money that we've had coming to our markets, both debt and equity, is significant, and I think would also be a important input to the future of interest rates in India. So on balance, my feeling is that while in some of the real interest rate sensitive, which is automobiles, infrastructure, etc., the good news is at a very early stages, beginning of the beginning maybe, but the market expectation is that there is a level of certainty about continuation of this good news, and however the markets would wait a bit and for some more definite and certain news.
Right. So from a consumption point of view, homeowners, borrowers, I mean, should they be concerned at all? I mean, should the Reserve Bank be concerned at all about this constituency, or are they taking care of themselves?
No, I think they're going to be concerned about almost all the constituencies, because at retail level they need to look at the savers' interest, because what we've seen in the last 2 years is a significant dip in financial savings, and that is purely because the real interest rates remained in a negative territory. On the asset side, obviously you need to look at the the growth triggers, and home loan and retail loans would be a point where consumption demand would be more showcased, so to speak. I think it's a little time away, because we are seeing that demand, though is gradually picking up. I don't think there are sustained signs of that robust recovery in demand yet. A simple thing of a PMI, so to speak, input and output prices, you're not seeing such a huge pickup in the output prices. That means to an extent the pricing power is not yet in the hands of the manufacturer. If you look at the PMI data incidentally today, it has actually dipped. So, we still need to get onto a sustained recovery whereas growth is concerned, be it through consumption or investment. Investment cycle will take a slightly longer time.
And that's not necessarily predicated on interest rates, is what you're saying.
Well, investment, predominantly it is more on the environment and policy environment. Interest rates matter, but I think it's not the most important factor.
Right, Ved, is that something you concur with?
I think
interest rates being only one of the factors that we are concerned about at this point from a growth point of view.
I think that's a fair comment, and I think there are several other areas we discussed the supply side issues earlier, which will also need to ease out for growth to pick up. In any uptrend, in the first phase, the driver of growth is sheer annual spirits of business confidence, right? And I'm sure you will agree that we've seen a sea change in that particular area. And the first uptrend, be it in economic growth or in the sentiment in the markets, has really been driven by these animal spirits. The one point I would like to make is that sometimes policymakers become complacent and believe that animal spirits are sufficient to carry it through. But I think we are at that very critical juncture in this entire uptrend where some policy support will be required, and which is why I made the point that markets would eagerly look forward to.
So can you give me one instance of what that could be?
So I would say that markets would eagerly look forward to a very definite sign that interest rates are going to come down. Because if you look at the market, several sectors have already, so pharmaceuticals, consumer goods, IT, several other sectors have already performed. But the real interest rate sensitives, if you see, are really waiting and watching. And the next leg of market optimism will really be driven by some of these, interest rate sensitive players. And my feeling is that if we wait for too long before we give definite signs that cost of money in this country will come down, and there will be support for some of these large projects and sensitive sectors to take off, I think we are in the danger of creating or prolonging the phase of mediocre growth that we've had in the past.
Right, and therefore one should be cautious, and therefore one should act quickly, convert some of this animal spirits into action.
From a policymaker's perspective.
From the policymaker's perspective. Thank you so much, both of you. We've run out of time. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.